Whew, that was a hell of a week on Wall Street. I feel like we're finally getting the weekend to rest and recuperate because there was a lot that went down. So in today's video, I'm going to be breaking down all of the events that took place, right from GameStop stock to short squeezes to Reddit to Robinhood. Basically everything that brought us to this monumental moment in history. So let's begin. Hey everyone, and welcome back to a very special edition of Finance with Arjun. I finally gave in to all of your Instagram messages asking me to talk about this big battle between retail investors and hedge funds that's gotten everybody talking about it. So that's what this video is going to be about. I'm going to try and keep it as simple as I can because I know it can get a little complicated, especially as a beginner investor. But if you have any questions about it, please let me know in the comment section down below and I'll be happy to answer them. I'll also be talking about what my thoughts are on this whole situation as well as what I'm doing about it. So make sure to stick around to the end of the video. Alright, so this whole saga began when a Redditor on this forum called wallstreetbets noticed that a stock called GameStop had been heavily shorted by big hedge funds. But what exactly does this mean? A short is when you borrow a stock from its owner and sell it immediately. You hope that its price goes down so that you can buy it back at a lower price and then return it to its owner. And you get to keep the difference between the two prices. Let me explain that through an example. Let's say ABC stock is worth $50 and a short seller wants to short 10 shares. He borrows those 10 shares and sells them in the market at the current price to get $500 in total. Now let's say the stock price drops to $40 a share. This short seller can now buy back the 10 shares for a total of $400. He can return the 10 shares to the original owner and keep the $100 difference. That's if everything goes according to plan. But instead, if the price goes up to, let's say, $75, then the short seller has to pay $750 to be able to return those 10 shares. So here he ends up losing $250. The dangerous part here is that these shares can continue going up to any level. So technically your losses as a short seller are unlimited, because you do have to return those shares to their owner at some point. The more the prices rise, the bigger are the losses. Just keep this in mind as we move back to GameStop. On noticing that there were a lot more GameStop shares shorted than actually existed, Redditors saw an opportunity to make lots of money at the expense of Wall Street. So they all teamed up and started buying as much GameStop stock as they could. When more and more people buy and hold, that's going to drive prices up. This puts hedge funds who shorted the stock in trouble. The only way they can exit their short position is if they buy back shares at these new inflated prices, and that sends prices even higher. This is what we call a short squeeze. And in this case, it represents a transfer of money from these big Wall Street investment firms to regular individual investors. That's what sent GameStop stock from under $20 a couple of weeks ago to over $300 at Friday's close. But what's Robinhood's role in all of this, I hear you ask? Alright, maybe you didn't, but I'm going to tell you anyway. Many of these individual investors were using Robinhood to buy these shares and drive prices up. And it wasn't just GameStop, the same thing was also happening with AMC, BlackBerry, Bed Bath & Beyond, Nokia, and a couple of other stocks. But what Robinhood decided to do was restrict the buying, but not the selling, of over 50 different ticker symbols. To be fair, there were a couple of other brokerages that made similar moves, but it was Robinhood's decision that seemed a little bit more shady. Robinhood's largest customer is Citadel, who helps them in routing transactions in the back end. Citadel is an investor in a big hedge fund called Melvin Capital, who had shorted GameStop and lost billions in the process. Although Robinhood does say that they limited trading to protect investors, a lot of people seem to think that they did this so that Melvin Capital can cover their short positions and limit their losses. All of these, however, are rumors at this point. We don't know anything for certain. There is a class action lawsuit that's going on right now that is investigating this issue. It is possible that Robinhood was acting in the best interest of their customers, but the general public seems to think that there was a conflict of interest that resulted in clear market manipulation. This would be a violation of the free market where technically, however risky it might be, you should be able to buy and sell as you please. Because of this, they got over 100,000 one-star reviews in the App Store, and investors decided to move to other brokerages like Webull, Fidelity, and Schwab. Given that they have an IPO coming up, this was quite a controversial move that puts Robinhood in a very difficult spot. Personally, I'm a little disappointed by this because I was a big fan of Robinhood when they revolutionized investing and had such a cool, slick UI. But it's their recent actions that are making me rethink investing with them. So I recently opened up a Webull account. I'll leave my referral link down in the description box below in case you want to do the same and get 4 free stocks in the process. Everything that's going on in the market has blown to such massive proportions that we have people like Elon Musk, Chamath Palihapitiya, AOC, all actively getting involved. We are literally witnessing history being made with average investors sticking it to the billionaire suits that rule Wall Street. It is very, very easy to get carried away with all this, especially when you look at people like DFV, who's made $46 million from a $50,000 investment in GameStop. This guy has literal ice flowing through his veins because he rode the roller coaster all the way up and still hasn't sold. But it's very important to know that all of this trading is not based on fundamentals. These stocks are not intrinsically worth that much. It's all very emotion driven. When everybody is getting in, making trades on margin and trying to make fast money in the market, that's when things get really risky. There will be a point when all of these stocks start falling back down, and inevitably a lot of people are going to lose money. So if you do decide to invest in these stocks, only put in fun money that you don't mind seeing drop to zero. This is not financial advice, but I'm just doing my part in ensuring that you all invest responsibly. Personally, I do want to be on the right side of this battle, so I did buy a couple of shares of AMC just to show my support. Over the long run, there might be something good that comes out of all this, but I just don't think it's worth risking my financial future for this. So I'm just gonna hold the fort down with my 3 shares of AMC. Although some hedge funds have lost billions of dollars and Wall Street is properly spooked, I don't think that this battle is over just yet. Retail investors hope to hold on long enough to see hedge funds eventually give up. But right now, it's still quite delicately poised and we don't know who's gonna break first. All of this points to a very interesting week coming up, and I'm going to be following it quite closely with popcorn in hand because let's face it, there's not really much else to do in quarantine right now. As always, don't forget to like this video and subscribe to the channel if you enjoyed the content. Let me know if you have any questions down below, and apart from that, I don't think I have anything else left to say. Thanks so much for watching, and I'll see you in the next one.